Okay, picture this. The news is buzzing about potential trade wars. The economy feels a bit shaky.
Yeah, a little uncertain.
Exactly.
Yeah.
And suddenly you hear about more and more people facing job losses. It really makes you wonder, okay, where might folks land on their feet?
Mm-hmm.
And the gig economy, the world of Lyft and Uber rides, Upwork, Fiverr, all those platforms,
Yeah.
it suddenly seems like a crucial alternative.
It really does. We need to look at the financial health of these gig economy giants. Are they strong enough?
Okay, let's unpack this. Starting with something pretty fundamental for stability,
Mm-hmm.
their financial strength. We're looking at the assets to liabilities ratio.
Right.
Simply put, for every dollar a company owes, how many dollars worth of assets does it have? A higher number generally suggests, well, a more stable financial foundation, doesn't it?
It does. And what's really interesting is how this picture has kind of evolved for these companies over the past few years. If we look at that first table, table one,
Hmm.
DoorDash had a notably higher ratio back in 2021 and 2022. It suggested they were in a very strong position then.
Okay.
However, if you jump to 2023 and 2024, well, Instacart's ratio takes a significant leap.
A huge leap.
Yeah.
Yeah, Instacart went from having like less than $1 in assets for every dollar of liability in those earlier years to having over $4 in assets for every dollar of liability more recently. That's a big shift.
They really
Makes you wonder what drove that. Maybe some smart financial management or perhaps a big influx of capital.
could be either or both.
Regardless, based on this latest snapshot, we're giving Instacart a point for overall financial stability right now.
Okay, now let's talk about who's actually bringing in the most revenue and, commanding the biggest piece of the market pie.
Sure. So looking at table 2, the overall story for the gig economy, as a whole, is one of pretty robust expansion.
Yeah, the total numbers look big.
They do. Total revenue across just these companies grew from about $34 billion in 2021 to over $76 billion in 2024. That's a significant increase in economic activity.
No doubt. But when you look at the individual players, Uber is just the clear dominant force, isn't it?
Oh, absolutely.
They consistently held the lion's share of the market, often above 50%. They're the undeniable heavyweight in this arena.
No question. So we're awarding a point to Uber for maintaining that significant market dominance.
Yep. But what's fascinating, though, is to see a subtle shift sort of happening beneath that dominance.
Oh.
While Uber remains way out on top, their market share has seen a slight gradual erosion over these years.
Oh, interesting.
And at the same time, DoorDash has been slowly increasing their slice of the pie.
Ah, okay.
It suggests a dynamic market where even the biggest players can see competition, chipping away at their lead, even if it's just a little bit.
That's a great point. It's not static.
Yeah.
Okay, as for which company has shown the most consistent upward climb in just raw revenue dollars,
Mm.
if we look back at table 2 again, Airbnb really stands out to me there.
Okay. Tell me more.
Well, they've demonstrated solid year-over-year growth, moving from just under $6 billion in 2021 to over $11 billion in 2024.
Right. That's pretty steady.
That kind of steady and substantial increase year after year, I think that deserves a point for Airbnb.
Okay. Fair enough. For consistency.
Yeah, it highlights how different segments of the gig economy can have their own unique growth stories. Uber might lead in sheer volume, but Airbnb has shown impressive consistency in just expanding its revenue base in that short-term rental market.
Agreed. Okay, let's turn our attention now to how quickly these companies are expanding their revenue. Table 3 gives us the percentage change year over year. Which company really hit the accelerator the hardest?
Well, that would definitely be Uber back in 2022. They had an impressive 82.62% jump in revenue.
Wow, yeah, over 80%.
That's a massive leap in a single year. So a point definitely goes to Uber for that remarkable growth spurt.
Okay.
However, and this is really important, I think, you have to notice that the overall pace of growth for the entire sector seems to have, cooled off quite a bit in 2023 and 2024 compared to that explosive growth we saw in 2022.
That's a critical observation. Yeah,
Yeah.
it raises the question, doesn't it? Was that high growth rate maybe a post-pandemic rebound that's now sort of leveling off?
Could be.
It suggests that the easy, rapid growth phase might be behind us, and these companies, they'll need to work harder to maintain significant expansion going forward.
Makes sense.
Now, let's talk about whether all this revenue is actually translating into profit. We're looking at earnings per share, or EPS, in Table 4. What does this tell us about their health at the bottom line?
Right, EPS. For those tuning in who might not be financial whizzes, It's essentially the slice of a company's profit that gets allocated to each share of stock out there.
Good way to put it.
Think of it like this. If a company makes a big pie of profit, EPS tells you how big a slice each shareholder theoretically gets. Looking at the 2024 numbers, Uber stands out again with the highest EPS at $4.56.
Pretty strong number there.
Yeah. So Uber gets another point for leading in profitability in the most recent year we have data for.
Okay. Uber is certainly demonstrating strong profitability right now. But like you said before about revenue, it's not just about one good year, right? We also want to see some consistency in earnings. Which company shows maybe a more stable trend in profitability, even if they didn't have the absolute highest number in 2024?
Good point. Looking at those EPS figures over the years, Airbnb shows a pretty steady climb into profitability. They were in the black in 2022, 2023, and 2024.
Right, 3 years running.
While their 2024 EPS wasn't the absolute highest, that consistent track record of actually making money year after year, that's a really positive sign of a solid underlying business, I think.
Agreed. Consistency matters.
So we're giving a point to Airbnb for the most stable EPS trend.
Makes sense. Okay. Now let's shift our focus slightly to how investors are valuing these companies. Table 5 gives us the price-to-earnings ratio, or PE ratio. What can this tell us about market sentiment?
Okay, PE ratio. This essentially tells us how much investors are currently willing to pay for each dollar of a company's earnings. It can give you a sense of whether a stock is considered, expensive or maybe relatively cheap compared to its actual profits. While there's no magic number, a PE ratio around 20 is often sort of considered a benchmark for a reasonably valued company, give or take.
Right, a common yardstick. And when we look at our table 5, Upwork really stands out, doesn't it? Lowest PE ratio at just 8.77.
Yeah, it's low.
And Uber also has a relatively low PE ratio, 17.01. That's quite a bit lower than some of the other players we're looking at.
True.
So based on this metric, we're awarding 2 points to Upwork for having the most attractive valuation.
2 points for Upwork, okay.
It suggests that, for every dollar of profit Upwork is generating, the market isn't valuing it as highly or as expensively as some of its competitors.
It's worth mentioning, though, a really low PE isn't always a straightforward buy signal, right?
Oh, absolutely not, no.
It could sometimes indicate that investors have maybe some concerns about the company's future growth prospects or maybe potential risks down the road.
True. Context is key.
However, in this context, especially when we look at Upwork alongside some of the other metrics, it definitely makes it an interesting case to consider from a value perspective.
Absolutely. Okay, I think it's time. Let's add up the score. Let's see who comes out on top based on our little points system here.
Right, final tally.
Okay, Instacart earned 1 point for showing the strongest financial stability in the latest data.
Yep.
Airbnb gets 1 point for consistent revenue growth and another 1 point for the most stable EPS. So that's 2 for Airbnb.
Okay.
Uber racked up 1 point for market dominance, another for the highest single-year revenue growth back in 22, and a third for the highest EPS in 2024. That's 3 for Uber.
3 for Uber.
And finally, Upwork takes those 2 points we just discussed for having the lowest PE ratio.
Right. So based purely on this financial snapshot, Uber appears to be in a strong position across several key areas, while, like you said, Upwork presents maybe an intriguing value proposition for investors.
That seems fair.